With you, because that's one of the main things that the union does is they send us out to the households to make sure people are educated. You know, I work with the UMWA and I have for 7 years now. What we found is 90% of the union people that we work with have some different type of whole life insurance and they don't understand how it works. So the first thing to understand is that there's 15 different types of whole life insurance on the open market, okay? Most people that I run into think that there's only one kind of whole life insurance on the open market, but there's actually 15. And out of these 15 different types of whole life insurance, only 2 of them will stay the same price and the same benefit amount for the rest of your life. Okay, the rest of them all have some kind of change that will happen. So the main ones that you will run into in your life will be universal, flexible, modified, adjustable, group, graded, straight, and guaranteed. Now, the other 15, the reason I don't go into the other 15 is because most of the time you won't run into those. Those are things that are done through the stock market and through employers. These are the main ones that you'll run into in your life, okay? Now, whole life insurance, the 2 genuine types of whole life insurance that you run into on the open market are straight and guaranteed, okay? And the way they work is very simple. From the day that you take out your policy, and I'm doing this with passion the whole time. Yeah. The day that you take out your policy, it locks in your age and health, okay? The whole time that you have the policy, you're building cash value at 4.5% interest that does go up with inflation over time, okay? And the day that you die, it's a guaranteed benefit that gets paid out to your family. A check gets put in your family's hands. Now, the problem is these 2 are the only ones that work like this, but the rest of these, it get explained the same way, okay? Yeah. So the next one I'm going to go into is graded. I'm sure you guys have seen the advertisements on TV where it says no medical questions required, instantly qualify, Alex Trebek, you know, what's that?
People will bite off Alex Trebek. Oh, I know.
Yeah, they know who it is. So, but the way these policies work is like this. When you have a graded whole life policy, and some people I've ran into, this is just me telling you, some people I've ran into, man, like, will just call and get the insurance from the TV and they'll be a year into it and not realize that if they die within the next year, they ain't getting fucking covered. They got to go 2 years. So the way this works is it's for people that are not in the greatest of health. Okay, and if you want to do this again and record me doing this so you can get it down, that's fine too. I should have thought about that, but we'll do it again. But graded, the way it works is you pay into it for 2 years. Now, if you die within the first 2 years, you're only going to get a percentage of those premiums back. Okay, what you're doing is you're paying up the risk that the company would normally forfeit because of the unhealthy situation that you're in. Now, after the 2 years, it's a good policy. It is. After the 2 years, it's a good policy. Some people run into these and they don't know they have them. Group insurance, the only company that I know of, Nick, that carries group insurance is AARP, Group Whole Life Insurance. Right. Now, you can call AARP all day long and they will tell you that the prices don't raise on their policy. But the fact of the matter is the life insurance actually doesn't come from AARP. It comes from New York Life, okay, which is predominantly a term company that you see on television, okay? So New York Life is the one who sets the standard and makes the decisions. So let's say that me and you, Nick, get into a policy with AARP, okay? So what happens is when you enroll, they put you in a group with hundreds of other members that are around your age who took out life insurance in the past 3 to 5 years, okay? So let's say that we're 2 people in a group of 300. I pay $50 for my policy, you pay $60 for whatever policy you have, and the rest of the people in that group have their own amounts of insurance they pay a different price for, okay? Right. Now, every 10 to 15 years, they do an evaluation on this group. Your price is based off the mortality rate of the people you're in this group with, so in West Virginia. So that means if 10 or 15 years later, they go in and evaluate that group, and they see that me and you are just 2 out of 80 people left, when we were once 2 out of 300, now the price for all 80 people will go up. Right. It raises. So that means that you could go from $50 a month one week and the next week be at $400 after 10 or 15 years. And a lot of people don't realize that's how that works. And then the last explanation I give them is I'll say, now these last four, universal, flexible, modified, and adjustable, these are the main ones that I run into. These are the main ones that people have. You can get way more coverage for cheaper through these places, but here's how it works. So universal, flexible, modified, and adjustable, normally your policy will say modified universal or flexible adjustable or something of that nature. So let's say, for example, Nick, that you have a $50,000, I don't know why my voice keeps cracking. You have a $50,000 whole life insurance policy, okay? And let's say that you pay $85 a month for that. These policies build at a lot higher interest rate than a genuine whole life does. These build at about 8 to 10% interest, okay? Now, whenever you take out a policy like this, you pay $85, but the company has a cost of insurance that they pay to give you the $50,000, okay? And it's lower than yours. So let's say that the company only pays $15 to $20 a month to give you the $50,000.
All right.
That means everything that you pay above the company's cost hits this interest rate, and that's how you build your cash value, okay?
Right.
So this is where your money builds up. And it takes about 15 to 20 years before anybody ever notices a change in these policies. But what they don't explain to you is that $15 to $20 a month, it goes up every year on an annual basis. Now, you won't notice this because they don't change your monthly bill. One way to find out too, if people have a universal, if they get statements more than one fucking time a year, it's because something's constantly changing. If they say, yeah, we get them every 3 months or every 6 months, it's because something keeps fucking changing in that policy. That's a telltale sign they got universal.
Yeah.
And they do send them statements for this shit all the time, but people are never taught to read them.
And
Okay?
don't be scared to call their insurance company and say your son. I've done that before and it's fucking
Yeah,
fire.
all the time I'll call their company and let them tell them exactly what they fucking have. But you have to build trust to do that.
Right.
So the way these are structured, Nick, is that whenever the company's cost of insurance, which you're able to gauge what the cost is by those statements that they send in the mail, but people are never taught how to read them, so they don't know.
Right.
But eventually you'll be able to see that $15, $20 a month that the company pays will eventually match what you pay per month. And most people that have these policies, usually after 15, 20 years, they'll have about 15, 20,000 built up in them. Your job at that point, you're covered for the whole life while it's active. But the main point of this policy is to actually make money. And this is just between me and you. I'm telling you this. These policies are actually the best type of policy you can get. Like if I were to get one, I wouldn't pay $85 a month. I'd overfund it to take advantage of the cash value before the company's cost of insurance matched up here. So you can build a ton of cash value if you overfund it.
Thinking about that.
If you overfund it. But people don't know to do that because they think that it's this. You know what I'm saying? So what happens is, this is where you're supposed to take the money out. Policy's canceled. You don't have it anymore. You've earned your money and you get it out of there. But people think that it's a whole life plan. So what they do is the company's cost of insurance continues to raise above what you pay. But see, you don't know that because your monthly bill doesn't change. That's why they tell you that the price doesn't go up, because you'll never see the bill change. Now, during the lifetime of that policy, now what happens is your cost of insurance, and personally I've seen it go up to like $1,700 a month, bro, for some people's policies. But let's say that your cost of insurance for the $50,000 goes up to $400 a month. And there are charts in the middle of these policies with decimal points that show every year where it raises and goes up in price. Yeah. And you can do the math on them and show what the cost of insurance will be. So instead of raising your monthly bill to $400 a month, they're going to take the $85 from you, and then the rest of that $400 is going to get pulled from your cash value. Okay? Now, once the cash value is dried up, you either have to pay the new premium or you lose your insurance. So, and the last thing that people don't understand is any money that you borrow from your cash value, whether it's to pay for excess cost of insurance or not, any penny that you take from here is considered a loan. So that means that once they've used up all this money, you actually owe the company that money because they've used it to pay for the excess cost of your premiums. So if you decide to take the new premium, what happens is your $50,000 policy that builds at 8 to 10% interest is now costing you $400 a month, and the company's cost is, we'll just say $300 a month, and you start all over from scratch again with nothing in your policy.
All right.
So that's, and then once I've said that, these niggas go running for their shit,
scared.
bro.
Yeah, no.
They go running for their shit. And I'll let you record me doing this too, so you listen a few times.
Yeah.
I know you